There are a lot of different ways to identify the liquidity zones on a gold chart. In this video, I will explain to you what is the liquidity zone and why is it so important. I will teach you a simple and effective strategy that will help you to identify the significant liquidity zones on any time frame. And watch this video until the end because I will also explain to you how to apply them properly. Please don't forget to like this video, subscribe to my YouTube channel, and let's start. And first, let's go through some important theory. Even the highly liquid market like gold does not always have the constant liquidity. While some price levels on the chart will concentrate the high activity of the market participants, some price levels will have the lack of interest. Take a look at the intraday price action on gold. We can easily recognize that there are certain areas on the price chart where the price tends to consolidate, where the trading volumes tend to accumulate, and at the same time there are a lot of levels where there is the lack of interest. The areas on the price chart where the trading orders and the market activity concentrate will be called the liquidity zones. And here's why these zones are so important. When there is no balance between the buying and the selling activity, the market will tend to go to the closest liquidity zone. The excessive buying orders will push the prices up to the closest liquidity zones, where the excess of demand will be absorbed by the sellers. Such liquidity zones we will call the supply zones. These are the zones that are above current price levels. Liquidity zones are the magnet for the price. The excess of supply will push the prices down to the closest liquidity zones where the selling orders, the excess of the selling orders will be absorbed by the buyers. Such liquidity zones we will call the demand zones. These are the zones that are below current price levels. And by the way, if you're wondering how to draw the zones properly, keep watching because I will also share the rules. The ability to recognize the zones is crucially important because it will help you to identify where the price is going, and also the zones provide safe and profitable trading opportunities. But how to find the zones? Liquidity zones can be identified with Fibonacci's, with technical indicators, with order flow. But one of the most efficient ways to identify the liquidity zones is to analyze the historically significant price levels. And here is the strategy that will help you to identify the liquidity zones on gold. In our example, we will identify the liquidity zones on a daily. And again, remember that the liquidity zones that are above current prices are the supply zones, while the liquidity zones that are below current prices are the demand zones. Your first task will be to identify the historically significant price levels. By historical significance, I mean that strong bullish or bearish movements initiated from such a level in the past. You can see that here we have a significant price level from where a strong bearish movement initiated. A bit lower over here we have one more historically significant structure, and here we also have a historically significant price level. You can see that these levels are lying very close to each other, and all these levels will compose a single liquidity zone. In order to draw the liquidity zone properly, take the highest level and the lower boundary of the zone will be the highest candle close. That is our first liquidity zone that we spotted on gold on a daily. Now let's try to find some demand zone. You can see that here we have a historically significant price level. A bit higher over here we have one more, and from that level we saw a significant bullish reaction. And right here we also have quite an important historical key level. All these levels will compose the liquidity zone, the demand zone. And in order to draw the zone properly, take the lowest level and draw the zone to the closest candle close. That will be your demand zone. And I see one more supply zone right here. You can see that from that level in the recent past a bearish movement started. And here we have a liquidity zone that is based on one single level. That is the supply zone that we should pay close attention to. And that supply zone here is very unique because if we analyze the price action on the left, we can also spot that from that level right here, recently we got a bullish movement, a strong bullish movement. That level should be taken into consideration as well. And in such a situation, our liquidity zone here will be wider. Here will be our entire supply zone. I also wanted to show you two more significant liquidity zones on gold. First one is based on three historically significant price levels. You can see that all these levels were important for the market in the past. And these levels will compose a huge demand cluster. You can see that I draw that taking into consideration the highest candle close and the highest level among these three. And we have one more liquidity zone here. That liquidity zone is based on multiple levels right here. You can see that we have a very important demand cluster right here. And again, drawing that demand cluster, I take into consideration the candle closes and the lowest level. After you identified all the liquidity zones, do not forget to clean your chart and remove all the horizontal levels from the chart. And here's how we apply the liquidity zones. First of all these liquidity zones will be the areas from where we will look for trading opportunities. From the demand zones, we will look for buying opportunities. And from the supply zones, we will look for selling opportunities. Once one of the liquidity zones is reached, your task will be to look for confirmation. If you want to buy from a demand zone, for example, you should look for the bullish imbalance. Also, you will apply the liquidity zones for forecasting. The violation of the demand zone, for example, and the candle close below that will turn that demand zone into a supply zone. And then the bearish continuation will be anticipated to the next demand zone. While a bullish violation of the supply zone will turn that supply zone into a demand zone. And then a bullish continuation will be anticipated to the next supply zone. Always remember that you can identify the liquidity zones on any time frame. However, the rule always is that higher is the time frame, stronger and more significant is the liquidity zone. Let me know, traders, in the comment section if you have any questions. Also, traders, let me know in the comment section what do you want to learn in the next video. And also don't forget to watch my other videos.